Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Romin.
And I'm Michael.
China's economic boom has slowed as debt, deflation, and demographics weigh on the economy. Last week, Beijing belatedly announced a massive stimulus package, cutting interest rates and funneling money into the stock market.
I want to know whether the measures are big enough to make a difference, and if now is the time to invest. And in today's dumb question of the week, what's the difference between fiscal and monetary policy? All right, let's get into it. So last week we did an episode called Is Europe a Basket Case? And Romin, I was so tempted to call this episode Is China a Basket Case? But I think it's fair to say they're going out of their way to make sure it's not. They've just announced the biggest economic stimulus since the start of the pandemic.
Yeah, I think at a certain point you just look at the economy and so many of the variables were flashing red that it was pretty clear you couldn't hide that. You couldn't just stop publishing all of those statistics. And yeah, they had to do something, and they have done something. The question is now whether what they've done is large enough to turn things around.
So what were these indicators which you would say were flashing red?
From my point of view, I think the biggest scary indicator was deflation. That's usually a sign that there's not a lot of demand in the economy. If prices have fallen year on year, then it shows that essentially the economy is fundamentally broken.
Did you see that all public officials in China were banned from using the word deflation? Literally can't say it.
Another red flag. So you've got an indicator that people can't talk about, and yet it's just signaling that there's such a fundamental problem. So think of it from the point of view of a company. If you're lowering your prices, people are buying your stuff, but thinking, well, I'll just put it off for another year, so prices will be lower if I do that. So you enter this downward spiral.
There's two sides to the coin, isn't it, here, about what's causing deflation. People keep pointing to overcapacity, as in Chinese producers are making way more stuff than they can possibly sell to the Chinese market, and therefore are desperately looking to export this stuff to the rest of the world. But also, that implies weak consumption within China, which has been a massive problem. And if you look at the stats, they have a ridiculously high personal savings rate compared to pretty much anywhere else in the world. So I've seen some stats that over the last decade, the household savings rate in China is almost 40% of earnings, whereas in most of the rest of the world, it's more typical to be somewhere in the region of 5 to 10%.
And what you often find is economists say that the worrying debt in China isn't a problem because of the high savings rate. So there isn't a huge amount of household leverage, which of course was the case in 2008 in the US and made things much worse.
There is a lot of debt in the economy, though. It's just held on the balance sheets of local government and banks.
Yeah, that's the problem. It's the shape of the debt and also the sources of revenue that go into paying off that debt, a lot of which came from the property market, either directly or indirectly.
I mean, one of the questions is, why do Chinese people have such a high savings rate? And the finger of blame often gets pointed at the social welfare state in China, that there is such a weak social safety net that people, build their own social welfare system by saving so much money.
Always surprising, because you'd have thought for a socialist state that they would look after their old people. And yet culturally, the way you do that is the family looks after you, but you make savings for when you're old. But that is changing, I think. For example, insurance companies are doing things like providing health insurance, or perhaps people are saving towards their pension by investing in the stock market. But of course, that's also one of the problematic areas in China.
It's still privately led, though, isn't it? Like, the state hasn't really stepped in. People say that President Xi is so worried of kind of replicating the Western model, which he sees as making people lazy.
But the way I see Chinese markets is there are essentially two things you can invest in. One is property, and the other one is the stock market. And what you tend to see is huge surges in one and crashes in the other, and then huge crashes in one and surges in the first one. So it's kind of like a ship which is listing from port to starboard as people rush to one side of the ship and then the other. And there's no point shouting, don't panic, because people can't invest outside China. There are still these strict capital controls. So it's a really unstable system. Maybe you could make money out of it by investing in whatever is the flavor of the moment. But Personally, I've cut off my Chinese investment altogether.
Put it in the too difficult bucket.
Yeah, I think it's just too hard to call.
I mean, certainly property has been the thing that's dominated their capital markets for the last decade. It became something like 20 to 25% of the economy all in. And lots of houses and flats were built, which were never sold and never lived in. And there has been a property market crash and a dry up in transactions. And part of this stimulus was a big attempt to get the market moving again.
But this revenue from the real estate sector fed into this huge bubble of debt which China generated, both for private companies but also local government. Local government funded itself by selling land to developers. And of course, you can only do that so many times. If you're selling the family silver, you can only sell it once. So one source of revenue for local government has dried up, and the primary source of revenue, in fact. And they built up all of this debt, assuming that that gravy train would continue. But of course, now it's slowing down.
And if you look at real estate prices, the price of new homes fell in August at the fastest pace since 2014. And that's on top of, 20% plus falls since the peak of the market.
So we are seeing the bubble deflate, and it's starting to get ugly, and it's starting to get into kind of disorderly sell-off territory. So clearly the government's going to have to step in some way. And my worry is that what they've done so far is too little too late. So effectively, we're still going to see a market which implodes, and the debt's going to become a huge problem. So just to summarize all of the problems, we've got deflation due to lack of demand. We've got very weak economic growth for China, still pretty good relative to the West, but bad for China.
If you believe the numbers. So they're targeting 5%. And I think everyone expected them to miss it, at least unofficially, which is one reason for the stimulus now.
And they've got to stabilize the property market, which is in free fall. Consumer spending is weak, so that source of strength for the economy has now pretty much disappeared. And of course, you've got to support capital markets. They've got to buy their shares in order to somehow bolster the market. So that paints a picture of an economy that's essentially broken, and they're trying to fix it.
And it doesn't help that over the last few years, you've had these kind of ideological policies which have cracked down on Chinese big tech companies. You've seen founders and CEOs disappeared and then reappeared and then disappear again. And unsurprisingly, foreign capital has been scared away. And there's a wild stat that I saw on Twitter, and we included it in the weekly market roundup newsletter. So make sure you're signed up for that. And this graph, which went semi-viral, showed that since 1993, if you look at the MSCI China index, and this is a total return index, so including dividends, it has lost money since 1993. So that's 30 years where investors in China would be out of pocket.
And compare that with India. India's gone up hugely over the same period. So there's clearly something not happening, which should be happening, if you want foreign investors to invest in your country via the stock market.
But it's kind of crazy because that 30 years of negative stock returns has come at a time when China's gone from a tiny share of global GDP to the second biggest economy, has lifted 800 million people out of poverty, according to the World Bank, has built its capital markets, has grown its companies, and yet shareholders have seen nothing.
And I think that's a decision. I think that was a decision on the part of Chinese politicians that the treasure stays in the country. If you visit China, it's interesting. The quality of life is very much sophisticated if you stay in the cities, of course. And they have converted a lot of people from peasant farmers into people who live in cities, who live pretty much the lifestyle that we do in the West. So that has been a huge success story, but not for investors in the country.
In terms of GDP per capita, obviously that's grown hugely, but it's still only around 30% of the level in the US. Obviously, there's a lot more people, so they're the second biggest economy. But, it's still a middle-income country, China.
Yeah, they still haven't broken above that kind of middle-income trap point of their development. They are getting there. I think the choices they've made have been good ones to dominate in technologies like artificial intelligence, but also things like electric cars, renewable energy. They're clearly trying to get in front of these trends, these long-term trends economically. And they've put all the infrastructure in place to do that.
But they've killed off their VC industry at the same time, which has been the source of, these companies which have grown in China. It was what funded the sort of 500 plus electric vehicle startups. There was a great piece in the FT which just showed that new startups founded by venture capital has basically stopped in China. If you want to start a company at scale, you need government money now.
It's a little bit like mowing the lawn from the Chinese point of view. Once someone becomes too successful, along comes the mower and chops off the head. You don't want to stick your head above the parapet, because if you do, you're essentially in the sights of the central government.
So I guess my fear as an external observer here is that, yes, China kind of got ahead of certain industries, like you said, electric cars, solar, wind, a lot of these green technologies. But are they going to do it for the next batch? Because they've killed off the sort of flow of new companies.
I think they could still turn this around, because all the infrastructure is there in place, the sources of commodities which feed into those industries and the ones abroad. So they could still fix it. But I think ideologically, their political system, whatever it is, it's not communism, it's not capitalism, isn't well suited to nurturing these companies. So I think that's going to eventually stifle innovation, because unless you have entrepreneurs, unless you have those really productive, innovative companies, and ultimately it's down to people that create these innovations, unless that's in place, they're going to fall behind.
So putting all that stuff about venture capital and private funding to one side, because I think that's the kind of thing that will play out over the next 5 to 10 years. The immediate problem was, like you said, deflation, property bubble, weak growth. Things were not looking good for the Chinese economy. And I think for months, years even, people have been saying the government needs to step in with a big stimulus package. And it didn't look like it was going to come until last week, finally, the government put its money where its mouth is.
Yeah, because essentially this is a fourfold stimulus. There's monetary policy easing, real estate support, stock market measures, and fiscal stimulus, which we can talk about in turn. The monetary policy easing is what they usually do when there's a problem where the PBOC, the central bank, the People's Bank of China, they cut the reserve requirement ratio, or RRR, which is unpronounceable, but I managed it. There we go.
Yeah, that was pretty good.
But the idea there is that commercial banks in China have to hold a certain amount of cash with the central bank, and by cutting the amount of money that they have to hold with the central bank, they've got more cash which they can then lend out to the real economy.
Is it basically saying banks can lever up their balance sheets a bit more?
Yeah, and lend more, and that stimulates the economy, you get more growth. And they cut it by 0.5 percentage points. So a fair old cut. And they also cut the reverse repo rate by 20 basis points, so it went from 1.7% to 1.5%, which makes borrowing cheaper. Hopefully that's stimulative as well. Now they may cut RRR further towards the end of the year.
Why don't people call it triple R? That would seem a lot simpler to say.
R cubed, that's what we'd call it, physicists. So that was one measure, and one that they often do, right? So that's monetary policy. Then we've got real estate support. So there they've cut interest rates on existing mortgages by about 0.5 percentage points. So cheaper to borrow, hopefully the prices go up, or at least stop falling so quickly. And then the minimum down payment for a second-time home buyer was reduced from 25% to just 15%.
I think what they're doing with the property market is looking at all those unsold houses, which are languishing on the books of property developers who are holding so much debt, and they just want to get them sold. So they've kind of reversed course, whereas previously they were trying to crack down on property market speculation, stop people buying second, third, fourth homes. Now they're saying, fill your boots. Just buy these houses, please. Get them off the books. And separately to those measures announced by the central bank, I saw that over the weekend, actually, several provinces in China liberalized their property ownership rules, because there was often these kind of restrictions where if you weren't like a local citizen, you weren't allowed to buy, or you had to pay more money or whatever. But Shanghai and Shenzhen have eased curbs, and apparently Guangzhou became the first tier 1 city to lift all restrictions on home purchases.
So tier 1 city, if you're not familiar with them, they are huge. Think London. It's really staggering when you compare the size of Chinese cities to ones in Europe, say, or the UK.
And it does seem to have had an immediate impact on listed property developers' shares. So I saw that Reuters reported that The Hang Seng Mainland Properties Index, which is listed in Hong Kong, jumped by 8% on Monday. And the mainland CSI 300 Real Estate Index rose by almost the same amount. And property developer shares generally are up around 40% since the stimulus measures were announced. And to be fair, they've been massively crushed over the last few years.
And even tech giants rallied. So companies like JD.com and Meituan saw their stocks rise by more than 8%. So we've seen widespread positive reactions to the stimulus, but that's exactly what you'd expect.
And there was direct intervention in the stock market from the central bank, or very close to direct intervention. There's like a little bit of a middleman standing between the bank and buying stocks directly.
And really interesting changes. So, for example, there's a 300 billion yuan re-lending facilities. So if you want to borrow money from a commercial bank to do a share repurchase where you buy your own shares and push up the share price, there's that facility in place to do it.
Yeah, so the central bank is kind of lending money on favourable terms to listed companies to get them to buy back their own shares, which is one way to revitalise the stock market, I guess, if you believe prices are unfairly depressed.
This is the key point. If you buy back your own shares, you're assuming that you're buying it back at bargain prices. And it's certainly true that in aggregate, the Chinese stock market is trading at a really low multiple. The future earnings that you're going to get, you're not paying a lot for those today.
I think the forward price to earnings ratio for the market as a whole is around 9 times forward earnings.
Compare that with US, which is like 21 times. So a huge disparity there.
I think it's the biggest ever valuation discount to the S&P 500 for the Chinese market.
And then finally, you've got fiscal stimulus. So the Chinese government's going to issue 2 trillion yuan in sovereign bonds. And presumably that's going to be used for some of these stimulus packages.
That's going to be used to bail out the banks, I think, if I had to guess.
Or the local governments, that's going to be really difficult.
There was another interesting measure where the central bank announced $500 billion yuan fund, which was going to go to institutional investors to buy Chinese stocks directly. That's around $71 billion.
Which is remarkable. The government, the central government, lending money to companies to buy shares.
Yeah, you've seen other central banks do it, though. I guess the Bank of Japan's bought shares even more directly than this. I don't even think they sort of lent the money to anyone. They just said, let's take it on our balance sheet.
I wonder if the Fed was looking at that and thinking, yep, we should add that to our list for the next crisis.
It's already on their list, Roman. Buy anything. That's the thing, though. Haven't central banks gone from being the lender of last resort to the buyer of last resort?
Yeah, so maybe this is even less direct than you'd get in the West. But it's interesting that they've actually decided to do this, that the stock market matters. Whereas in the past, I think they'd see the stock market as not particularly interesting and they'd focus on social measures to help people rather than stocks.
Why have they waited so long? People have been calling for this kind of package for ages.
I think partly it's admitting failure. If you step in and try and fix things, it shows there's a problem. And maybe they didn't want to admit there was a problem. Plus, I think they didn't want to encourage people to speculate further. So they wanted to deflate this housing bubble gently. But what actually has happened is it's starting to accelerate the implosion of the bubble. So I think it's really just trying to smooth the ride down in order to get through to the other side.
Do you think it's just a coincidence that this is happening just after the Fed finally cut interest rates? Do you think it's possible that the authorities in China thought, if we do this massive stimulus while the Fed is still hiking or still has rates really high, then clearly the renminbi is going to suffer, China's currency will devalue, and there'll be volatility. Whereas if we sort of wait for the Fed to move, then we're just easing at the same time as the Fed is easing. All is good.
Yeah, I think that's probably true. I think they certainly did pay attention to what the Fed was doing. You see that across the world. When the Fed moves, everybody has to do something. Otherwise, you're out of sync with the biggest economy in the world.
The market liked it.
Oh, yes. And of course, I sold my K-Web shares just before this, but...
You're joking!
But no, pay attention. This is important, right? So I moved it into that copper portfolio. So that's benefited from this stimulus. And so indirectly, I'm still okay.
Yeah, less than this. Your Chinese shares would have benefited. You'd have rallied like 40%, right?
No, I knew you'd say that. So I checked just before this podcast, and it was fine. It was fine. No, the copper stuff is doing very well. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. If you trade US stocks, then 24/5 trading gives you non-stop market access from Monday until Friday via more trading sessions, while still using Trading 212's fractional shares and zero commission trading. You can also switch between 24/5 and regular hours orders at any time. Customers can also benefit from the Trading 212 card, which offers 1.5% cash back on all transactions until October the 1st, 2024. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1 and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than you invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You're responsible for all investment and rebalancing decisions. Free shares can be fractional. Terms and fees apply.
And the Chinese market's had a bounce now. So on the day that the stimulus measures were announced last Tuesday, China's stock market jumped 4% immediately. And for the week, it was up nearly 16%, which is the best week since November 2008.
And my copper stocks, up 20%.
But if you look at the graph, right, zoom out, always zoom out. Look at the graph of Chinese stocks. It's a pretty big drawdown since that peak in 2021. And you've got this little tick up now at the bottom.
So to summarise then, big problems in the economy, big stimulus package. And now the question is it enough? Is it going to be a long-term stimulus, or are they just going to back off and hope things are going to recover based on what they've done?
Hot take, it's not enough. Do you disagree?
No, I think that's probably true. I think they're going to have to do more. And they probably will wait to see how this stimulus package affects it, whether it's going to be enough. But I don't think it will be enough.
Let's put it in scale, though. This stimulus package has been estimated to be valued around £1 trillion. Whereas in 2008, when they pulled out the big bazooka, as everyone said, and actually went first, I think, with economic stimulus, that was around 4 trillion yuan. And that was at a time when China's economy was much smaller. And it seems to me that the problems in China's economy now are comparable to 2008, or maybe even worse.
Just to put that in perspective, £1 trillion is about $143 billion. And just remember, the size of the Fed's balance sheet was $9 trillion. And that's what they consider a large stimulus. So I think China's going to have to do far more because its economy is not much smaller than the US. So to get over this hump, they're going to have to do more, I think.
There are hints that they will do more. So presently, the stimulus has been led by the People's Bank of China, its monetary policy for the most part. Like you said, the central government is talking about issuing a lot more bonds and injecting that capital into the banks, maybe into local governments, trying to boost liquidity, get over this debt trap they're in. And they're clearly taking it seriously. So they've just had the September meeting of the Politburo, which is led by President Xi. And that doesn't usually focus on economic policy, but this time it did. And the mood music coming out of it was very stimulative.
So yeah, that hint is going to stabilise markets further based on expectations. But then if they don't deliver, it's going to probably turn things around again and probably drive prices down further. I think also the problem that China faces is the huge amount of debt which they've got. So if you look at the total social financing, and that includes not just central government debt, but also local government debt, local government financing vehicles, and also things like corporate debt, household debt. The total is around 300% of GDP and creeping upwards. Now, for a country which is supposedly starting to deflate its debt bubble, that doesn't look like it's doing it very effectively.
Is this what people mean by causing a balance sheet recession, like we saw in Japan?
Yeah, this is very much like a balance sheet recession. So just to explain what that is, it's when people pay back their debt. So it's completely rational for people, for companies to deleverage in this kind of environment that we see today. But by doing that, they're not investing, they're not spending, and that exacerbates the problem, which is exactly what happened in Japan in the 80s. And that led to a really extended and deep recession, and stock markets took many decades to recover from that bubble. Now, the guy who came up with that balance sheet recession thesis and who wrote the book about it is Richard Koo. He's a Taiwanese economist, and he was actually interviewed about it. And he said one of the benefits is that people can see what happened in Japan and learn from that experience, because what he says is required is government stimulus. So clearly, they've listened to what Richard Koo said, and they're trying to not repeat what happened in Japan. So maybe that will help them through this crisis.
The similarities are obvious with Japan, right? Big real estate crash, lots of debt, a big export industry, which is possibly going to shrink. You've got tariffs and a trade war now with China, deflation, falling productivity, and crucially, very, very bad demographics. So China's population has shrunk for the last 2 years, shrunk by almost 3 million, in fact, last year. And their working age population is set to fall by 40% over the next 30 years.
And again, this is one thing that people often misunderstand about China, which is that it is an aging population right now. And it's not a young country, and it's getting older.
The population over the age of 65 in China was around 100 million in 2005, and that will double to 200 million by 2025 and double again to 400 million by 2050. That's a lot of old people for a shrinking working age population to support. And I did see that China has controversially started to raise its retirement age from very low levels, right? It was like 50 something, which is way out of kilter with most of the rest of the world.
So these are the problems of becoming a developed economy.
Boomers everywhere.
Just let me point out, I'm not a boomer. I just missed that category.
Chinese boomers are younger, though. Their boom came a bit later.
Yeah, true.
But that is probably the biggest long-term issue facing China, as it is a lot of countries, actually. Aging populations are difficult to deal with. But in the short term, everyone's focused on this stimulus package and potentially more stimulus. And is that going to reverse the terrible few years the Chinese stock market has had? What do you reckon? Now the time to buy Chinese stocks?
I think there's going to be a medium-term boost in Chinese stocks, and perhaps some of the derating that we've seen will turn to a re-rating as the price to earnings multiples increase. So I think directly investing in the Chinese stock market may be one way to do it, although a lot of that boom has already happened, I think.
I'm so skeptical, though, about investing in the Chinese stock market. What we said, right? 30 years where China's done really well and their stock market, for foreign investors at least, has done terribly. What makes you think that the government is going to let that change? My sense is they would like foreign capital, but with very low return on investment for foreign investors.
Well, one way to do this is to buy state-owned enterprises where clearly the government's going to support the companies in which it has a stake and avoid the things which essentially are subject to this lawnmower approach of cutting companies down if they're successful. So you can buy SOE-focused ETFs, for example, or you could go indirect. You could go to one of the countries that exports a lot of its commodities or its other exports to China, countries like Australia, for example, or you could buy the commodities which China buys in order to fuel its economic growth. So copper, that's the way I did it, or perhaps Australian stocks. You could buy an ASX index tracker, or you could go for one of the economies which is tightly bound to China. For example, Indonesia, Malaysia, Singapore, Thailand, all of these countries have those very strong links to China. So if China benefits, so will they, probably.
The way a lot of people talk about playing it, if you believe that Chinese demand will recover, is to buy things like European luxury goods companies, which sell a huge amount to China. I think China is maybe their biggest market, or maybe second biggest after the US.
So LVMH, for example, Burberry.
Yeah, all those things I'd never be seen dead in. And then you also have stuff like car manufacturers, where if you look at the reports issued by BMW, Aston Martin, Mercedes in recent months, they've all said our sales are way down because Chinese people just aren't buying our cars. If you believe that's going to turn around, then they're an obvious play. But just to go back to your point on state-owned enterprises, my belief, based on pure skepticism about China, is that that's the worst way to play it, because I do not see any situation where China will allow investors, foreign investors, in their state-owned companies to make strong returns on capital. They'll either run those companies in the interests of the people and squash margins over the long term, or they just won't be honest with the accounting. I just can't see it. Right? You invest in some sort of quasi-government entity in China and expect 10% yearly returns, you're not going to get it. Surely you're not going to get it.
Yeah, I think you might have a point. I think that probably a good way to do this might be with these indirect routes rather than going directly to Chinese stocks. Plus, there's always that binary risk that China becomes uninvestable and your money's going to be trapped there. At least if you were doing the indirect ploys via copper or other countries, you'd be able to pull your money out.
You get these massive shifts in sentiment, don't you, every few years from investors related to China. Like suddenly it'll become in vogue and people will be whacking like 25% of their portfolio into Chinese stocks, convinced that it's now is the time where it's going to have that massive rally and fulfill its promise.
But it has been the widowmaker trade so many times. And I think people will learn that and be really cautious about investing in China.
If you're going big on China, you have to believe this time is different. Is it ever different? Maybe.
You can probably tell from our discussion, it's very difficult to tell when something is a value investment or when it's a value trap. But if you want to discuss this with other people who are like-minded, who have a long-term investment mindset, you can do that on our website by going to pensioncraft.com/membership.
Okay, today's dumb question of the week is, what is the difference between fiscal and monetary policy?
Now, professional investors are kind of obsessed with these two forms of stimulus, so it's really important to understand it as a retail investor as well, I think. But the key idea here is that if the central bank cuts interest rates, that's monetary policy. There's conventional and unconventional monetary policy. Unconventional would be things like buying government bonds. Conventional would be things like cutting interest rates or cutting that reserve requirement ratio in China, for example. Fiscal policy, on the other hand, is done by the government, from which the central bank is hopefully independent. But here it's about government spending. How much is the government spending through buying services, through employing people, through direct investment in the country in order to stimulate the economy?
Can I summarize it fairly as saying monetary policy is about determining the amount of money and credit in the economy, and fiscal policy is tax and spending decisions?
Yeah, I just finesse that by saying that monetary policy is also about the rate you pay. It's not just about the amount of money.
The cost of money.
Yeah, the cost of money. It's kind of tweaking that.
But it sounds such a simple division. But has it been complicated over the years? And do these two things, fiscal and monetary policy, always act in the same way, or do they sometimes come clashing into opposition?
It's an interesting point about why they are kept separate. So, for example, recently, it was a question that was directly asked of Jerome Powell during one of these monetary policy meetings. Because, of course, we're thinking about a second Trump presidency, and he's clearly very interested in having low interest rates because he sees it as stimulative and it flatters the economy. And this is the fundamental problem. And Jerome Powell's response was an interesting one. He said the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favours maybe people who are in office as opposed to people who are not in office. And he goes on to say that the data are clear that countries that have independent central banks, they get lower inflation. So if you offer bread and circuses, yeah, low rates for everyone, free money, well, that's going to be inflationary. It might get you re-elected, it might provide a shot in the arm for the economy short term, but it's eventually going to cause problems with inflation.
Interestingly, China does not have an independent central bank. The People's Bank of China, as you'd expect, is kind of subservient to the central government. And yet they do have deflation. I mean, the PBOC works in a bit of a different way, I think, to Western central banks. It's been less focused on interest rates historically, I think, and more focused on directly ordering commercial banks, which are part owned by the government often, to lend money and how much and who to and on what terms.
Yeah, I've heard that they do have a red phone in commercial banks where the central government can phone them and say, look, you remember that loan that you should have provided to this company? Well, we think you should provide it. I think it's a figurative red phone rather than a kind of bat phone-like thing which sits in the corner of the chairman's office.
I mean, you could say that in that terrible weekend in 2007, 2008, when everything went wrong in the US, there was red phones at commercial banks in the US. No? Wasn't the Fed on the phone to everyone?
I think the phone probably went red when the president phoned some of these banks and said, how much risk were you taking? How much equity on the balance sheet? How many loans?
Isn't that the point, though, that this separation of powers, if you want, between fiscal and monetary policy all gets chucked in the bin when there's a crisis?
Yeah, because when there is a crisis, the central government is expected to bail everyone out. And they have done, very clearly they have done repeatedly over the last 3 decades.
Could I make a controversial suggestion, which is that QE, quantitative easing, is a kind of blurring between fiscal and monetary policy. So that's when the government sells government bonds directly to the central bank, effectively, or the central bank steps into market to buy government bonds and depress yields. It's one step removed, but it's kind of like monetizing fiscal deficits. I guess the argument is, we're going to reverse QE with QT one day. So it's just a temporary measure.
And you could say that central banks are now in a position where they can't raise interest rates too much because of the huge debt to GDP ratios. It would crash the economy and it would go against one of their remits, which is stability.
That's what people call fiscal dominance.
Yeah.
So much debt that the central bank's really constrained. And the worry is that if they can't raise interest rates as high as they should be, then you'll get inflation.
But, and I think this is the big but, if the central government telephones the central bank and says, cut rates to stimulate the economy, and the central bank sees data that clearly shows that would be inflationary and not in the interest of the economy for the vast majority of people, my belief is that banks in the West would say, no, we will not do that. We're going to act in the best interest of the economy, not to get you re-elected. That's my belief.
They didn't say no to Nixon in the 70s when he did exactly that.
No, they didn't. And I think that was a mistake. The famous example is Arthur F. Burns, who effectively caved in to Nixon and potentially allowed inflation to get out of control in the 70s by not hiking soon enough. But if you look at central banks now, I just think that the answer would be a flat no. And I think that's the right answer.
The independence of central banks is a kind of curious thing, though, because they are an arm of government, even in the West. And the division is kind of like the democratically elected government sets the rules and the targets, and then the central bank has to deliver policy independently, which achieves those goals. But it also kind of has to adjust for whatever fiscal policy is doing. So after the financial crisis, we got austerity from a lot of governments. Some economists say that was the wrong policy. We should have been targeting support at areas of the economy that needed it, but they didn't do that. They tightened their belts. So then the central banks had to respond and say, well, if you're not going to stimulate the economy, we're going to have to cut interest rates to zero, did all this QE and everything. But that's a really blunt instrument, and arguably inflated asset prices, and the real economy took a long time to recover. Did we get the balance wrong? Like, should fiscal policy have taken up more of the mantle? Because with fiscal policy, you can be a bit sort of discretionary and granular and pick your battles, whereas monetary policy is a blunt tool.
I think there should be two modes. I think during normal times, and yeah, it's impossible to define what that means, but during normal times, there should be absolute independence of central banks. During periods of crisis, I think that's when central banks have to operate hand in hand with governments. And look, they'll all be paddling in the same direction at that point anyway, like during the COVID crisis. fiscal policy and monetary policy kind of worked together during that crisis. And that was a global phenomenon. And if there was an exogenous shock, like some kind of huge natural disaster, everyone would work together to stimulate the economy.
Because it's interesting you said, if the government rings up the central banks and says, please cut rates, and if the central bank doesn't think that's wise, it should say no. I'm more interested in the other way around. What should have happened in 2009 is the central bank should have rung up the government and said, could you please spend a bit more money?
I think they did say that. And I think if you look at what happened during the COVID crisis, clearly the Fed was advising central government to spend more and to do the fiscal stimulus.
So independence works both ways or not?
Well, they advise, I think. I think it's certainly the case that government will ask what they should do. They'll take it as one other source of advice.
Central bank says, we're independent. If you don't spend more money, we're going to crash the economy.
That would be great, wouldn't it? Fine, we'll hike.
Who's the captain now?
Yeah, I'm the captain.
Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.